it's critically important that you have some gold and silver now, but, we've really been taught that they're just a worthless relic, although, year over year, up, 89% central bank gold buying, so maybe not so much of a worthless relic, because we have really been taught that Wall Street is the only option, and I'm here to tell you it's not. Because what there's been, jittery markets buckle as Powell signals they must go it alone. And I've got to tell you, people are thinking, oh my goodness, so if I'm going to sell my stocks, I'm going to turn around, I'm going to buy something else, which I'm going to show you in just a second. But market breadth, that and depth, that is the number of shares that are being traded and expanding, is back again to March 2020 levels. I mean, this was the depth of the current crisis, right? And there are so many signals that are taking us back to that place. Maybe that's where we should have been all along. Maybe what we have just experienced and witnessed is a massive risk transfer from the few, the insider selling, to the many, the naive public. That's what we need to really talk about, because the market depth is collapsing. So, the big question is, will ETFs, exchange traded funds, save you? No. And neither will the Fed. Because liquidity is evaporating even before the Fed taper hits the markets in, let's see, when is that going to happen? Oh yeah, March. And here we are in February, and this was from August. So things have been shifting for a while. Somebody might know something that you don't as you're just watching the markets kind of chug along, but the breakdown in depth has been remarkable. And the liquidity alarm has been sounding, right? When this goes up, that means liquidity is going down. What's liquidity? Liquidity is the amount of money sloshing around in the markets. So what this really is showing you is that all of this new money printing that has been going on since 2008 is not really stimulating the real markets. Yes, it's pushed all the stock markets and the bond markets and the real estate markets, those markets that were targeted by the Fed. They actually came out and said that, for those that remember that were listening to me back then. They actually came out and said that they were going to target stocks, bonds, and real estate for reflation, but it's losing its steam. With every subsequent QE, the impact was less and less and less. And what we're seeing is breakdown behavior. This kind of like a bridge that, is swaying in the wind when it shouldn't be swaying in the wind. And then what happens? It collapses. We don't know exactly when it's collapsing, but since 2008, the Fed has been training the markets, the public, to buy the dips, buy the dips, buy the dips. Well, because the Fed has your back, and maybe they're going to again. They're saying no. It's going to be interesting to see. Right now, what we all need is a wealth shield. And shields, financial shields, any kind of shields, frankly, they're much better when they're made of metal. So put your shield in place today, because we're all going to need a shield.